And I think that's even if you're not looking for an investor at this moment, or maybe even later, still I think it makes sense to assess your own idea through the eyes of an investor. Because as an entrepreneur, I think you are the biggest investor in your own company. And I think it makes sense to assess your proposition from time to time, and also to see where there's room for improvement, and maybe room to increase the potential or increase the feasibility of your idea. So for the second part, I'll talk about startup valuation, and that's basically the discussion about is this company, the Unicycle, is it worth 3 million or is it worth $1 million? And that's a very tough question to solve, but I'd like to show you some techniques that maybe give a bit more feeling to do so. I was here also last year to talk about startup valuations, and I made this slide because back then it seemed that all the tech companies raised equity at a valuation that was going through the roof. For example, Uber had a new round, $40 billion valuation. Even our Dutch Agen came into the field of the unicorns with a valuation higher than $1 billion dollars. So last year it seemed that the valuations were up and up and up, and that there was like some kind of a bubble coming up. I'm not sure how well you follow this news, but when I looked at valuation, the word valuation in my email from just last 2 weeks or so, I saw a whole different picture. For example, the collapse in tech valuations, I think a month or 2 weeks ago or so, because some of the larger corporations like LinkedIn, they lost a lot of money. They are listed on the stock exchange, so they lost a lot of money, and now we see that investors are getting a bit more scared and don't want to invest at such high prices anymore, which is maybe one of the first signs of a bubble, where as soon as the first one step out, and it all collapses. But we'll see. I'm not really sure about it, but I think two interesting graphs. The first one is on the left corner, on the top corner. This shows the valuations compared to the revenue. So what's the multiple of revenues that makes up the valuation? And you see, as of in 2013, there was a real peak. I think 13.4. I cannot read that well. 13.4 times revenue was the value of the company. 13.4. And now it's just 4 times. So there was a large decrease in valuation as related to the sales, to the revenue of the company. Another interesting picture is this one here in the bottom, where it shows the date where a company became a unicorn company. And I think you're probably familiar with the term unicorn. It's when a company has a valuation, like a private company with a valuation of $1 billion plus. So it's worth a lot. And you see that here there were just maybe every 2 months or so, there was a new company turning into a unicorn company, and then all of a sudden in January, maybe every day or so. It's unbelievable how close these lines are in the graph. And then now you see that the pace is slowing down a bit. And I think that if you extrapolate this graph, we'll see that there are less and less new unicorns born every day or every month. So I think it's very interesting what happens now in the markets, and I think this is also mainly in the United States, where I think there's a lot of air in the market. For the Netherlands, I think it's more stable and conservative and so I think there will be not so much effect here.
I just want to make a quick comment. It reminds me of when the dot-com bubble busted in the US. It has a lot of similar themes.
Yeah, I think the main difference now is that the companies do actually make some revenue. And back then, if you had a .com name, then you already were able to attract a lot of capital, and I think that really put air in the bubble. But now, I'm not sure. I think it's about the startup hype maybe. I'm not really sure what causes the bubble. I think it's also like a pyramid game, right? Where everyone wants to be on top of it. And if some players fall down, then the whole system collapses, more or less. But we'll see how sustainable this is. For now, I would like to ask you this question: why would you need a valuation of your company in the first place? So, any thoughts? There are multiple good answers.
For the value of your stocks.
Yeah. And what do you mean with stocks?
Well, if you have stocks and you don't have a valuation of your company, you don't know for which price you can sell it. Or
Sell to who?
well, if you're a public company to everybody.
Yeah.
If you're a private company to.
And as a matter of fact, for public companies, it's easy because you know what their stock price is.
Yeah.
So you can determine as an investor if you want to buy stock or not. But for private companies, which are not listed yet, it's very difficult to determine the price of a stock or a share. But why do you still want to know the price or estimate the price? Think of the example that we saw with Unicycle. Why did they want to know their price?
So that they don't undersell it, maybe?
Yeah, of course, yeah. What's the value of your company? Well, if you go to investors, they want a piece of your company, so you have to know what the entire company is worth, so you can price the piece that you want to sell. And there's some more. I came up with this list, but probably there's some more reasons. But I think it's also nice to know, right? So, what's your company worth? Well, if you have an investor on board, then there was a first valuation, so you have a bit of a sign what your company is worth. It's also nice for measuring progress. So let's say last year if you were worth 1 million euros and right now you have another investment round and you're worth 3 million euros, then you've made some nice progress. And it's also important, I think, to understand the principles behind the valuation, because it can help you to improve your company and to see the strengths and weaknesses. Because I'll teach you some of the methods that investors use, or for example on crowdfunding, if you go to Simbit you also get these methods. If you for example understand that the more risk you have in your company, the higher the prices that the investor wants, then you can come up with solutions to de-risk your business model. And if you know that, for example, the risk is used in the discount factor to price the company, the more you de-risk your company, the lower the discount factor, and the more your company is worth. So there are some mechanics there that if you know them well, then you can also increase the value of your company. And hopefully that's what we're going to see later on. Obviously, if you want to raise an investment, because then you have an investor who wants to know the price of the shares. But also, for example, if you started your company with 2 guys and you want to add a third one as a co-founder, then he also has to get some of the shares. But what are the shares worth? What's a fair amount of shares that you will give him? That's also maybe not like a very explicit valuation, but I think in a certain extent it is an implicit valuation, because you have to determine what this person is worth in terms of shares. And if you want to sell all of your shares, then you're talking about an exit. And what's the price of your company then? So a good friend of mine had a company called Distimo. He was in the app analytics for apps and for mobile. So he tracked all the analytics for every app that you can download. And he sold his company, I think, last year to the #1 player in the world for, I don't know, a couple of million euros. And I think also then when you sell your whole company, then it's really nice to know what your company is worth before you undersell it. And don't get the most out of it. So there are just some reasons, there are probably some more, but at the same time, it's very hard to come up with a valuation because in the first place there is no or very small track record. And with track record we mean history. So as an established company you have history and it's easy to extrapolate the sales figures, for example, to next year and the year after and the year after. But as a startup it's very hard because maybe you don't have any customers yet, so you have maybe not even a clue when the first customer will be, if he's willing to pay for the product, how much he's willing to pay, when the next customer will be. So it's very hard to kind of come up with the revenue line and from that to derive a valuation out of that. There's also a thing, it's called illiquidity, which means that it's not like the stock market where every day, every hour, every minute you can buy and sell stock, shares. And because then you have a market price, right? What's the market willing to pay for the share right now? If the price is high, then maybe some people want to sell their share and the other way around. But for a startup company, there is no such thing as a stock market for private companies. So you don't know what you're worth because you're illiquid. You only know what you're worth if you have an investor, a new investment round, for example. And that makes it that I think early stage valuation, startup valuation, is more an art than a science. Nevertheless, I want to teach you some of these scientific principles. But keep in mind that it has mostly to do with also the negotiations and the click with the investors to determine the value of your company. But the idea is simple. If we look at the principles, and this actually is something that we have already more or less discussed with the unicycle, but the post-money valuation, so the value of your company, is the pre-money valuation plus the investment size. So that's simple, right? So suppose that a company, Venture Inc., is looking for an investment of 1 million euros and that they agree during the negotiations with the investor a pre-money valuation of 4 million euros. How much of the company's equity will the investor require? It's actually not that hard. It's sorry, 5%. 5 million? No, it's what percent of shares?
25.
Yeah. 20 and 25. Who said 25? Why do you think 25?
Because it's a fourth of the worth
Of what word?
of the pre-money valuation.
You think 1 million divided by 5, obviously, right? Is 20%. So there's a difference here, but the correct answer is 20%. And the calculation is as follows. So the post-money is pre-money plus investment. So the pre-money was 4 million, the investment is 1 million, the post-money valuation is 5 million, and the investor is willing to invest 1 million of the total post-money valuation. 5 million is 20%. Okay, that makes sense, right? And if we visualize this, it looks a bit like this. So as an entrepreneur, let's say you have 100% of the shares, so you have a small pie, and you think it's worth 4 million. Then the investor comes willing to invest 1 million, so the post-money valuation increases with 1 million to 5 million, so the pie gets bigger, but you lose part of the pie, 20% in this case. Okay, makes sense, right? And this is so this is the easy part, right? But now there are all kind of factors who determine your value, the price of your shares. First of all, there are some market forces, and as I said before, the criteria, the weights of the criteria are different in Sweden and the Netherlands. And this also is true for the valuation. So if there are a lot of investors searching for the one great company, what do you think that will do with the valuation, with the typical valuation? Will increase, yeah, because there's more supply of capital than there is supply of great startups. So there's a market balance there. And also, I won't name them all, but for example, if you really want a deal, in the Netherlands you have, in most countries you have closed funds, so you have a 5-year investment period and then a 5-year divestment period. So you try to sell the companies that you have participated in. So the whole fund runs for 10 years, sometimes 11 or 12 years. But if you're at the end of your 5-year period, and you still have some money to invest, and your shareholders, you agreed that you would invest your whole money, so the shareholders are pushing you to invest, then maybe you are more willing to pay a premium to get in a deal, which means that you are willing to accept a lower valuation just to get into the deal. And so there are some more market forces. There's also some extras for the investor, so the more effort he has to put in, for example by attracting human capital, or introduce the company to their network of clients, then probably they want to have a lower valuation because they have to also put in some of their own works. Also the assets of the business, for example, if you have a patent, then that's something that you can maybe, even if the company goes bankrupt, then you still, if you own the patent, then maybe you can generate some money with that. Or the value is also based on the revenue model of the company. If you have, let's say, a consultancy-based company, then you are selling your own services only once. But if you are a SaaS company, so you sell software as a service, as let's say license, so every month you pay Spotify 10 euros or so, then you have very predictable revenue streams, and that's also more interesting for an investor. So these are all kinds of factors that can influence the valuation. So there are different methods to come up with a valuation. So this is where the actual calculation comes into place. The first one is the cost-based approach. So let's say if you put in X hours of work and you price your own hour at 100 euro, then your company is worth this. So that's very simple, and that's maybe not the best way, because usually you don't take into account the potential that's still in the company there. So I won't focus on this one too much. Then there's based on the future cash flows, and I will discuss the discounted cash flow method later on. How many of you are familiar with the DCF, the discounted cash flow method? So not too many actually. So I will briefly discuss the discounted cash flow method, also because that's the method that we're going to apply in the case study later on. Then there is the market approach based on, for example, multiples in the market, and we also saw it with the revenue valuation multiple. So now it's 4 times sales is your valuation, and based on that, based on market multiples, you can benchmark your own valuation with similar companies. Then you have the pragmatic approach, the venture capital approach. I will also discuss it with an example. And you have some more advanced methods, for example the decision tree analysis, where you kind of make a model where you have decisions which go, how do you say, you have multiple decisions, and based on each scenario there will be a different outcome, and you have to calculate it back to determine what your value is now. I won't go into that in too much detail, but let's have a look at the discounted cash flow method. Are there any questions so far about startup valuation? Are you still with me? So the discounted cash flow method basically says that you in the future you are going to generate cash. You're going to generate revenues because you're going to sell your product, and you can imagine that the further away that cash is, the more risk there is that the cash will never be there, or will be there in lower amounts, for example. So the discounted cash flow method takes into account the risks of future cash flows, because the money today is worth more than the money tomorrow. And for startups, maybe you are familiar with this method and you have applied it on, let's say, established companies. For startups, you use a discount factor, sometimes even up to 50 or 60%, meaning that the cash flow tomorrow is not worth, let's say, the cash flow, but half of the cash flow, for example. So you'll see that it goes very fast. The more risk you have, the less the future cash flows are worth today. Does that make sense? Do you have a question?
What's the name of this in Dutch? Do you know?
Verdisconteerde kaststroom. I think in Excel, Excel comes up with all kinds of crazy translations for this.
Yeah,
I think there is also verdisconteerde kaststroom, something like that. But I think DCF, or discounted cash flow, is most common, also in the Netherlands. But the discounted means that you divide the future cash flow by a certain number. That includes the risk. So the discount factor is also more or less the risk factor. And you see this in this standard formula. So you have cash flow at time 1, and you divide it by 1 plus the discount factor, or the interest rate sometimes used, and etc. etc. So in times 2 you already square it instead of just 1. So every new cash flow in the future, the further away, the less the cash flow is worth. Okay? If you visualize this and come up with some numbers, then you see that in year 1, the cash flow of minus 150,000 is discounted to minus 100,000, which is great. But then in year 2 you make you have a cash flow of 120,000, and if you discount it back, it's only worth 53,000 euros. And you see here the difference is even bigger, and that's because it's further away in the future. So there's more uncertainty. In this case, I will just go quickly through the formula, because this is what we will do also later on. But you have a question already?
Well, the small letter n, does it refer to the number of years?
Yes. In this case, it's years, but you can also use months, for example. Yeah. So let's see. I think these ones make sense, right? So it's just this divided by 1 plus, in this case, 1.5. So 1 plus 0.5 times this one. But in the last year, if you forecast for 3 years, you don't take just the cash flow, but you take the EBIT, which is, let's say, the profit, and you multiply it by an industry multiple. In this case, 6.8. Why? I don't know. I found it that on the internet that this is a common number, so 6.8, and then you have, let's say, the cash flow in year 3, because it doesn't make sense to predict the future for 5 years or 10 years ahead if you were started. So my suggestion would be just predict for 3 years ahead, and then take a terminal value, meaning that you just assume that your company will continue to grow at a certain pace. And we use this trick here to make it very simple. And this 1.4 million, you also have to discount it back to in year 3, so divided by 1 plus 0.5 to the power 3. Is that more or less clear? Because I don't want to go into too much detail now. We will apply it also later. And then I can also help you with that. You were first, so.
Why do you use in the first year as an R 0.5 and in the second and the shouldn't you 0.7?
Oh yeah, I made a mistake then.
Ah,
I think it's 0.5 everywhere, but I forgot to adjust it in the below.
alright.
So the formula, let's say the picture is with 0.5, but I forgot to change it in the
Okay.
sharp.
Where did you get this value of 0.5?
Sorry?
How did you get this value of 0.5?
0.5. Good question. In this case, I took it based on literature studies that suggested that for startup companies in a certain phase, based on their failure rates, etc., a discount factor of between, I think, 40 and 60% is recommended. And it's very high, especially if you're used to discount factors for established companies. I won't go into too much detail about how they come up with R there, but it's usually somewhere between maybe 10 and 15%. So, and also it has a large effect on the valuation. If you change this, well, to 0.7, then you'll see that the total value will decrease immediately.
By that logic, at 0.5 should have come down in year 3.
Sorry?
See, as the company goes older, this discount factor should have reduced.
I don't understand.
As the company would grow in years, in year
Yeah.
3, it
Yeah.
would go to a low instead of 0.5 to be 0.1.
Why should it be 0.5 in year 3? Because the company would have now grown.
Because you're predicting now, and you're calculating back the future cash flows to this moment in time. For example, if you are doing the same exercise next year, so let's say year 1 is done, and this is year 1 now, then maybe you can use, for example, 0.4, because you have already de-risked some of your business model. But the more risk there is in your company, the higher the discount factor is. And based on literature, they suggest that for startup companies, it's somewhere around 50%, which is very, very much. And you will see it has a large effect on your valuation. For established companies, it's much lower. Any questions on this? Because otherwise we'll just apply it, and I think you will see that there is some logic behind it. So this was the discount cash flow method. Then I also said something about the market approach based on benchmarks. Because it makes sense, if you have a very similar company and you know that it's worth maybe 2 million euros, then it makes sense to say that you're also worth 2 million euros, right? So that's a very theoretical model. In practice, you see that there's no company equal to yours. And if there is, then you don't know, then it's also very hard to determine what their value is. So you can, of course, compare yourself to companies that are already listed on the stock exchange, because then they have to provide more information. But then the comparison is even more difficult because they're much further, they have lower risks, and you're just a startup company. So you have to also take that into account. But you can use some multiples. For example, if they sell, if their value is X euros per dollar per revenue, for example, then maybe you can use these multiples to come up with your own valuation. You have a question?
Yeah, my question was for companies that are of this stock exchange, was you talking
Stock
about?
exchange,
Stock
yes,
exchange,
listed.
thank you. How do you get this information?
Well, they have to provide it because they have to disclose a lot of information. For example, well, the stock price, you can just look it up. It's on the IX, for example. But they also have to publish their annual reports, which includes a lot of financial information as well. So if you're a listed company, then you have to disclose a lot of information. But if you're a private company, if you have your startup company, you don't want to disclose too much information, because it only costs you time and it doesn't give you anything back. Only other people can take advantage of your information. In both cases, so let's say if you have companies with known valuations, So if you compare yourself to a $2 million company, or if you find market multiples, so the multiple between sales and value, for example, 8 times sales, then you should use the run rate. And the run rate is, let's say in January you make, what did I say, 10K revenue. That means that, assuming that your revenue will be the same, that in the whole year your revenue will be 120K. So that's your run rate, 120K. And then your valuation is, for example, 120K times 8, because that's the multiple that you found in the market. Then your value is 960,000, right? So it's quite simple. You just find a comparable metric and you adjust it a bit to your situation, and then you multiply it by that. And then the method that I think is used most often by, at least by venture capital investors, they just say, I have a bag of money and I'm willing to invest between, for example, 200,000 and 500,000 euros, and I always want a minority share, which is, let's say, between 30 to 40 or between 25 and 40% of the shares. And that's always the same, because that's their investment strategy. They always want a minority share, they don't want the majority of the shares, they always want a minority, and they always have to invest a certain amount, maybe 200 to 500, maybe 1 million to 2 million, it's always the same. So this means that they have an implied valuation. So for example, if you have 200,000 euros for a valuation of 40% for 40% of the shares, then you're worth 500,000 that's the best case scenario. And if you get 500,000 euros in exchange for 30%, then you're worth 1.7 million. So your valuation is always somewhere in between these two ends, right? But if the investor is not interested, your value is still 0. Any questions so far? Yes?
Okay. Can you go back 2 slides?
2 slides?
So, in the second case, you say that we can compare the value of our company to the value of a similar company.
Mm-hmm.
I want to ask my question by giving an example. Suppose Facebook purchased WhatsApp for some billions of dollars, right?
Mm-hmm.
And what is the chance that any company like Facebook is going to purchase any other chatting company for that much amount of money? I don't think there is a high chance of that.
Mm-hmm.
So is this strategy actually fair? Because for entrepreneurship, uniqueness of the idea is one of the most important features, and how your idea can be unique and how it is valued by some other company is I think it is totally unpredictable, or is it?
Yeah, I agree. Because it's as I said, it's very hard to find a similar company in the first place. And maybe if there is, then how unique are you? And second of all, you don't know what the value of this company is. So even if you can find one, then it's very hard to transfer his value to your value. And in the case of WhatsApp, I don't know. I mean, I think it's not fair to compare yourself with WhatsApp if you are just a chat software. But if you have that many users as WhatsApp, or maybe, I think WhatsApp is basically a user-driven model. So I think in that case you can compare yourself with a company similar to also, let's say, chat software with also an amount of users, and see what their value per user is. And that would be a more fair way of comparing yourself, instead of just comparing yourself to the very successful companies. But I agree, it's very, very hard, and it's only, I think, a little bit of this. But I think in any way it's a little bit of this. So I think these are just some methods that can be used, and maybe you can use not just one method, but combine a couple of methods and see if there's some consistency in the valuations that you find. I think, yeah, and that's maybe also the point that I wanted to make here. There are some inherent weaknesses of early stage valuation because the cash flows are uncertain, difficult to predict. The discount factor has a very large impact on the valuation, but yeah, research says it's something between 40 and 60%, but you can even imagine that there's a huge difference between applying 40% and 60%. So it has a huge impact, but you still have no idea which one to use. It's hard to find similar companies. You cannot compare it. So it's difficult. But I think if you want to be serious about it, then at least try different valuation methods and see if there's consistency. There's also a company in the Netherlands called Equidem, and they also allow you to use different valuation models. For example, the DCF, and maybe also the pragmatic approach of VCs. And they can also show you, so you're somewhere between this and this. But still, it very much depends on the numbers that you put in. They won't tell you this is what your company is worth. They just calculate the numbers that you put in and give you an answer. So still, it's crap in, crap out, right? So in order to avoid staring blind at the numbers, instead try to understand the assumptions that go behind the valuation. And if you understand the assumptions, then you also, I think, better understand what can increase the value of your company or can decrease. So as I said, risk is a very important factor. If you are able to de-risk your business model, then you will see that automatically your valuation explicitly or implicitly will increase. And there's also another way to postpone the valuation discussion if you want to go to an investor, and that's, for example, by not taking equity investment but take a convertible note. And there are also some pros and cons for convertible notes, but the convertible note is that you start with a loan. So as an entrepreneur, you get a loan, and then you have to pay it back after a certain period of time. But if there is another investor, maybe 1 or 2 years later or 3 years later, who wants to invest equity, then the convertible loan guy can convert his loan into equity. So he also gets equity, and he also gets like a premium price, like a discount factor to obtain that equity. So do you see? So you start with a loan, and then if there's another investor, you can also go with that valuation in the next round. So you postpone the valuation discussion to a later moment when another investor enters the company. Does that make sense? Okay. Before we go to the case study, one more question. What do you think is the valuation of the average startup in the Netherlands that raises equity crowdfunding? So simple. So what would be the average valuation? Any thoughts? Is it 10 million? Is it 10 euros?
10k, 100k?
Sorry?
10k, 100k?
10 to 100,000? Yeah.
500,000.
500,000? Anyone higher? It's about valuation, right? So maybe let's start with what would be the average investment amount?
1,000.
1,000?
Or 2,000.
It's yeah.
The total that they're expecting to receive from investors.
So it's equity investing. So for example, the average project on Symbit, per project, what is the average investment amount? What's your guess?
I'm gonna say 4,000.
4,000. Okay. It's actually 100,000.
Yeah.
Or a bit more even. So with that knowledge, what would be the average valuation, do you think?
Million. About 1 million.
About 1 million? So 10%
Yeah.
equity? Okay, makes sense. Yeah, I think that's true. So it's even 1.6 million. So the average project raises or wants to raise 109,000 euros, and in exchange they offer 6.6% equity. So their implied valuation is 1.6 million post money. To me, it was quite high, but I'm not sure what you guys are thinking. Any thoughts? High or low or? Yeah.
Yeah, I think it's a little high. I would have guessed about 1 million
Okay. Yeah.
instead of the 1.6. Yeah.
Yeah. So we did look at because this is the research I did myself. I looked at all the projects to see what their valuation is and also if they're making money or not. And this was even more interesting, I find, because so for all the companies it's 1.6 the valuation on average, but for the companies that don't make any revenue yet, it's 1.3 million. So they don't have any proof that that there will be a customer. They have no proof that you will pay for the product. So no market demand yet. So quite a lot of risk, but yet 1.3 million in valuation. So to me, it's very high. For the revenue companies, it's more difficult to determine, I think, because some of them already make thousands of euros per month on revenue. So it's harder to say if 2 million is a fair valuation or not.
So this research wasn't done in the Netherlands?
Yes, it's only Netherlands. Sorry, I can't hear you.
You told us in the former slide in the beginning that there were no investors in the Netherlands when there was a company that didn't present to make revenue.
Well, what do you mean?
Oh, okay, sorry.
Okay.
Investors would step out in the first slides. Investors would step out if you could ensure that you.
Yeah, but these are crowdfunders, right? These are crowdfunders, so it's different. And crowdfunders are guys like you and I. Maybe they don't have the investor hat on, or maybe they didn't go to this workshop last year, because otherwise maybe they would have thought twice, or they just really like the idea and don't care so much about the financial component. I think that's basically what's going on. Yeah.
Okay, just so I'm clear, when you say pre-revenue is they haven't sold a single unit yet, so it's basically those guys who come on Shark Tank and say, okay, here's my business idea, and here is here is the product I built. I haven't sold any yet, but I plan to in the future. Is
Yes.
that what it is?
Yes.
Okay.
So do you have any? If you see on Shark Tank what their average valuation would be for just let's say idea stage companies or pre-revenue companies? Do you have any reference to that? Or?
I can't remember off the top of my head, but I know it's much lower than companies who've sold, and I think the 1.3 is quite high.
Yeah, I mean, our friends from Unicycle sold for $1 million, so their valuation is even lower than the average pre-revenue company in the Netherlands.
So the Dutch more, I want to say, do they have a higher risk inclination or something like that? Since this was taken on Dutch.
You can't say it like that, but I really think that's more ignorance, right? So they don't really know what they're into. I think. So in my opinion, I think there will be also like a shakedown of crowdfunders. So I think a lot of people will be disappointed when there's a lot of bankruptcy for crowdfunded projects, and then if they're disappointed, then probably they will shy away in the future. So I'm really curious about what we're going to see there. You have a question?
When we didn't spend a lot, can you give us some examples about their products or services?
About the pre-revenue companies?
Those companies.
Yeah, it really depends. So there are a lot of apps.
Okay.
A lot of apps. Okay, let's say the top value. How do you say the top score was a company. It's called Only Once, and they offer like a data locker. I'm not sure if you how do you say, where you put your bank money in?
Safe.
Safe, yeah. So data safe, where you can store all your passwords and everything, and then they also came up with some kind of business model, which I don't really understand. But I think for consumers it's free, and for businesses they have to pay a certain amount. Okay, right? So that's more or less the case. They valued themselves at an 8 million euro price, and they haven't sold anything yet. Their product is still in beta, and probably they enter the market later this year. And I was really very much surprised by their valuation.
That's the value they gave themselves.
Yeah, but also
What's the value of the
they succeeded. So there was obviously there was a crowd of investors who wanted to invest at an 8 million price point. I don't understand, but yeah, probably there are some fools there. Yeah.
So in general, how many crowdfunders are like involved in this 109,000 euro?
Crowdfunders or projects?
No, like crowdfunders.
I don't know.
Because I mean that makes a big difference, I think, because the risk for, 100 people is like 1,000 euros. But if it's like 20 people, it's way higher. So
I agree. If you come up with a portfolio
for people to, it's easier to risk, 1,000 euros with 100 people and putting the revenue so high instead of like one investor who puts in, I don't know.
That's true. Because then you're spreading your risks. But still, if you have a portfolio of overpriced companies, then maybe one or two will really have the upside potential, but then still you have a shit price. Okay, let's do one final question on this topic, otherwise we run out of time.
Guys, we were wondering how about the success of all these very expensive companies? Is it like all these companies were very successful also, or were because they were maybe big, very intelligent, expensive companies, and all the food companies were not outside or something?
I think it's too early to say anything about the success of the companies, because most companies are not that old yet. So probably some will succeed and some will fail, but maybe it's too early now to tell. And we over the past year we've already seen 2 bankruptcies for crowdfunded equity projects, and it only makes sense that there will be more because statistics say so, right? So I have no idea what the future will bring us, but in any case, I think this has to do about the price that you pay for a company, and I think the failure rates are maybe even the same, but it gets very difficult as a startup company which raised money at maybe 1.3 million without any revenue. If you then go to a follow-on investor, let's say you with the money that you raised, you are able to bring your product to the market and get some initial customer feedback and some initial revenue, and then you decide to go to a venture capital investor, for example. Then he says, I am not willing to pay to invest at a 1.3 million price. So then what happens then? Either there's no deal because the investor just says, no, I don't want this, it's too expensive. Or the investor says, I do want this, but then we have to decrease the valuation. And in that case, all the participating crowd investors, they lose even more of their shares, they dilute. So then you end up with even less of the company. So I'm honestly very curious about what will happen in the market. But I don't want to say that you shouldn't crowdfund, even if you have the capital. But I'm only telling that you should do it wisely and take also the valuation into account, and don't only go for the nice movie of the pitch or the great story of the entrepreneurs. So yeah, you should really dig into it, I think. And maybe a final slide about the crowdfunding valuations, because I also find this one very interesting. Here on the, I think it's not the 8 million company is not there yet in this sample because it just raised like last month or so. So there's one here also. And the majority is, let's say, somewhere between 500,000 and 1 million euros. So just to give you a bit of a feeling about what valuations are in the market. And if you are planning to raise capital for your own company, then you can use this in your advantage, I think, to see also what the market is doing. But also keep in mind that sooner or later there will be maybe a follow-on round where you also have to convince investors then that they still get a fair deal. So this is what I discussed. Okay, so are you ready for the case study, or do you have any questions about the startup valuations? Okay. I've printed out a case study. I will discuss it also first, introduce it in the slides. So my idea is that we separate into groups of 4 or 5 people, and we are going to come up with the value of this company, takeaway.com. Who is not familiar with takeaway.com? It's a food delivery company. You're not? It's thuisbezorgd. Does that ring a bell? Thuisbezorgd.nl?
Oh yeah.
So you order food and they deliver it to your door. And they get a fee of every euro that you order, right? So they raised capital, I think, to be honest, 2 years ago from Prime Ventures, one of the leading, the largest venture capital funds in the Netherlands. The details of that deal are in the press release, which I also printed out. The assignment is try to estimate or guesstimate the enterprise value of Takeaway by using a very simplified discounted cash flow method, and that's actually the method that I just showed on the screen. And let's assume that R is 0.5, 0.5, that the industry multiple is 6.5, that you can use to calculate the terminal value based on the EBIT, the profit, in year 3. And the free cash flow is 0.3 times sales. And the free cash flow is the input that you use as the cash flow. So that's 0.3 times sales. And EBIT is, just to simplify things, it's 0.4 times sales. So that's the first question. What's the value of Takeaway 2 years ago when they got the deal? And the second question is, with that information, how much shares did Prime Ventures get in that deal? So based on the recent deal only. Are there any questions about this assignment? So it's 9 o'clock. My only bottleneck is that I have to go back to Utrecht, so I have to look up when the last train is departing. But let's try half an hour to work this case out. And maybe you need Excel to run this, or maybe you can just do some simple calculations on the back of a sheet. I'll just walk around, and if you have any questions, then just ask. And let's see if we can find what the Prime Ventures got. Okay, so who did come up with a solution for the first and second question? So, what were your value, total value of the takeaway.com? So just shout, what were your values? Did you come up with a total value?
60%.
No, let's start with value, valuation. $23 million?
60 million.
So the post money, so with the investment. 270 million. Okay. Anyone higher or lower?
97.
97? Okay. 68? 90?
60.
60? So somewhere between 60 and 100 and 270. So it's okay. I mean, this I don't know all the parameters myself, but I think it's about translating little pieces of information into some kind of model and add some assumptions, and then see what comes out and see if it makes sense. Because I don't know the answer myself, but let's I'll walk you through my assumptions, and then let's discuss what your assumptions were and see if they match or are very different. Maybe the last question, so the shares for Prime Ventures. Let's also shout for that answer. Did you came up with that percentage as well?
31.
31? 18? Okay, that's I think exactly also my my number. Are you? Did you? Okay. Other, it's somewhere between 0 and 100% for sure. Any suggestions? Okay, let's have a look at my assumptions. So these were my inputs. So these were actually the numbers that I gave on the paper or were in the text. And my assumption was that obviously takeaway, they have 1.7 million transactions per month, and you have to calculate it back to the currency, to the sales. And my assumption was that the average transaction price is 20 euros, and the average fee is 15%, and also that the number of orders increases 20% each year. But I think most of you also had similar numbers, right? Or did anyone have very different numbers? You guys had 3% transaction fee. 3% I think is very low actually. Was there anybody else with around 3% or 5% or so, or did you all were, let's say, in the range between 10 and 20%? Yeah, I think what I remember is that it's somewhere between 10 and 20 also, but I'm not sure myself. So let's go for the majority and say that's somewhere between 10 and 20%. Then this is what my model looked like. So I made a distinction between the different years, and I started in 2015, and let's assume that that's year one. So, by the way, I've also uploaded this calculation slide to a Google Sheet, and I'll share the link with you. I'll also share the presentation with you, so if you're very interested, you can also look up the formulas behind it. But in this case, the number of transactions times the average fee, average price per transaction times the fee resulted in, let's say, 408 million euros per year. So also the month times 12. I do say it wrong. So for takeaway.com it's 61 million in year one, and probably that's something also that you had more or less. If you discount it back, then the free cash flow. Free cash flow is 18 million in year one, 22 million in year two, 26 million in year three, and for year the terminal value, I calculated the EBIT in year three times the industry multiple of 6.8, and then I came with 29 million euros, which is obviously a large chunk of the total value, but you also have to discount it, and then if you all sum it up, I got around 100 million euros. So I think it's actually quite similar what we all had. So let's assume that we were correct, right? No, I have no idea, but I think it's more or less true. So if the pre-money valuation is, let's say, 98 million euros, and the post-money valuation is 170 million euros, because I added the 73 million investment. And prime, so that includes 73 divided by 170 is 43% of for the whole consortium. And Prime Ventures had what was it, 30 million investment of the 170 is 18%. So this would mean that if this was the first round, that entrepreneur would still have the majority of the shares, 57%. But this was not the first round, but I think the second round. So I think the CEO, Jetse Groen, now has a little less than the majority of the shares, so a little less than 50%. And below is the link, so if you're interested, you can look it up. You have a question?
I thought Prime Venture spent 43 million in total.
In total, yeah. But it's a combination of 2 investment rounds.
The other one was already in there.
The other one was in maybe 2 years before. Yeah. So in this round, I only included the 30 million. Yeah. Are there any other questions about this example? Is it clear? I mean, obviously we had limited information and incomplete, and we had to fill the gaps with some assumptions. But I hope at least that some of the methods that we used are you're now getting familiar with them, and you can also apply them for your own company maybe later, or if you are starting to invest also maybe in crowdfunding campaigns, to see if the companies really are worth what they say they are worth themselves.
Can you show the previous slide again?
Sorry?
Can you show the previous slide?
This one?
No,
this one? Yeah. Okay, just a small recap, and then I think there's a drink. So if we go back to the start of this lecture, it's about investor readiness. So what are the criteria that venture capital investors apply? And I think this is very relevant for you as maybe future entrepreneurs to know about these criteria, so that you can use it in your advantage for your own company, and also to have like a reflection moment, and to have it as a mirror to see if your company is using its full potential. The second part was about startup valuation, so I explained some of the principles. The simplest thing is that pre-money valuation plus investment is the post-money valuation, but then also I explained the more difficult methods and calculation tools that you can use. And please keep in mind that it's still more an art than a science. So you can really calculate it to multiple numbers behind the dot, but it doesn't make any difference, because it's all about the assumptions that you put in. So please be very aware of the assumptions, and try to really how do you say, put your company to the test, not only on the hard value that the output is, but also have a good look at what you put in, because crap in is crap out, and you only fool yourself. So with this said, I would like to conclude my lecture. If you have any questions, then you can always send me an email, or contact Olga or Aniek, because they also have my details. I'll also share the presentation with you, and I'll stay for 10 more minutes for a drink, and then I have to grab my train. So thank you very much for your attention.